In this video, I'm going to run through the top ETFs and index funds you can buy today. These ETFs will be grouped into 5 categories. We are talking global ETFs, US focused ETFs, emerging market ETFs, ETFs that track trends, industries, and even commodities like gold. I'll also be sharing key details about each ETF and also explaining some of the jargon as we go on, or maybe at the end. We'll see how that goes, right? The first type of ETF or the first group is the global ETF. This is a perfect set and forget it ETF. So if you're thinking about diversification, this is where you have the ultimate choice. You can diversify in an instant. You'll be investing in the whole market. That means you don't need to worry about picking the next Apple or the next Tesla. You are invested in everything. There are 2 ETFs I would look at in this category. The first is the Invesco All World ETF Accumulating with ticker symbol FWRG. These ticker symbols are actually unique identifiers that you can use to search out each ETF. So the expense ratio is 0.15 per annum. That means you pay £15 for every £10,000 invested. It was launched in 2023, but it has already amassed about 1.1 billion under management, and it's still growing very fast. It has about 2,438 companies within it, and here are the top 10 with their weight in the pie. And as you can see, the total weight of this top 10 is actually 21% compared to the other 2,400 stocks. The site that I'm actually using to research ETF, which I'm showing right now, is the justetf.com. You will find the link in the description. With this ETF, dividends are actually automatically reinvested into the fund. And that's what that accumulation ACC means. The second and older, bigger ETF that we'll look at in this category is called the Vanguard FTSE All World ETF with ticker symbol VWRP. The total expense ratio is 0.22, so it's more expensive than the Invesco. It has about £16.1 billion under management. It holds over 3,500 companies in this ETF. So you can call this the granddaddy of global funds, right? It is more expensive, yes, but sometimes you pay for that reliability, that size, and the sheer massive and reputation that Vanguard has. That's really what you're going to be paying for with this ETF. So if I would ask you, right, put in the comment below which one do you think is right for you. If cost is something that you're obsessed with, then maybe the Invesco would be the right option for you to invest. The second category of ETFs will be the S&P 500. Almost every finance person says invest in the S&P 500, and it's for a good reason. Even the Oracle of Omaha himself. So the question then is, why do everyone say invest in the ETF? And the reason is simple. It tracks the 500 largest US companies, which is roughly 75% of America's entire market cap. And don't be deceived here, because these companies are actually global companies. For example, your Apple, your Microsoft, your Google. So think of it as the growth engine inside your portfolio, because these are big tech companies. These companies are what's driving the world as we know it today. The first fund we'll look at in this group is the Vanguard S&P 500 ETF, VUAG. And the expense ratio is about 0.07%. It's absolutely ridiculously cheap to buy this fund. This fund manages 20.8 billion pounds in as assets under management. That's enormous, right? And there are about 503 companies with this fund. The top 10 companies make up about 33.3% of the fund, and it's totally dominated by the Magnificent Seven, as we'll call it. All dividends are automatically reinvested because it's an accumulating fund. This ETF is perfect for compounding, especially during your wealth building phase, right? Another option is the PDR S&P 500 ETF with ticker symbol PYL. This is even cheap, right? This ETF is cheaper, with expense ratio of 0.03%. Yes, you heard that right, 0.03%. That's £3 for every £10,000 that you invest. That's very, very cheap. This one has got about 8 billion euros assets under management, and it's growing rapidly since it was launched in 2023. It holds the same 503 stocks as the Vanguard ETF, but you're keeping about 0.04% more to yourself. S&P 500 is great, but what if you want something like maybe pure tech exposure? If you believe maybe tech is the future, or maybe something like artificial intelligence or quantum computing or robotics. The next category of ETF we'll look at is the NASDAQ ETF. And the ETF we'll look at in this category is the Invesco EQQ NASDAQ 100 ETF with the ticker symbol EQQ. Expense ratio is 0.3%, so it's a lot more expensive, and it manages 7.8 billion euros under management. This fund holds 101 companies within, and here is where it gets concentrated. The top 10 companies make up about 48.3% of the entire fund. So Apple, Microsoft, Nvidia, as you can see on the screen, they absolutely dominate the fund. Quarterly cash dividends in these funds are reinvested manually, or you could take the income. But here is the reality check. When tech company crashes, this fund actually crashes really, really hard. Remember March 2020, right? Just the start of COVID. The Nasdaq dropped by 30% in 3 weeks. But here's the flip side. If you had held on, your money would have doubled by 2021. There is a fund also that makes this Nasdaq ETF even look diversified. And those are the next categories of ETFs we'll be looking at. There are niche ETFs. You're going to be investing in specific industries, and you could easily get bond with this category of ETFs, or your returns could be crazy. The past returns for these ETFs are actually solid, but remember, past performance should not be the reason for investing. Research the industry. And the first ETF that we'll look at in this category is the iShares S&P 500 Sector ETF with ticker symbol IITU. So if the S&P 500 is the 500 companies in America, the IITU are the tech companies in that S&P 500. The expense ratio is 0.15%. It manages about 10.2 billion euros of funds. But here's the crazy part. It only holds 70 companies with that fund. The top 10 holdings of the ETF, as you can see, make up a staggering 75% of the whole fund. And as you know, they're the usual players. This is a pure play, big tech without fluff ETF. And it's perfect if you want to bet heavy on tech companies like Apple, Microsoft, without buying their individual shares. Another ETF in this category is the iShares Automation and Robotics ETF with ticker symbol RBT. This ETF tracks companies across the world that are developing technology in the field of automation and robotics. So think of factory robots, surgical machines, AI-driven software. The expense ratio is 0.04%. Higher fees, but for specialized exposure. It manages 2.3 billion pounds of assets under management. This fund holds 146 companies across the US, Japan, Europe. The top 10 holdings make up about 29%, which is much more diversified than pure technological ETFs. So this is your play on automation revolution. Another ETF, which is my favorite, is the Van Eck Semiconductor ETF, SMGB. This ETF tracks companies that are active in the semiconductor space, right? And for those that don't know, semiconductors is actually a very important component that powers almost every tech as we know it today, from your smartphones to AI platforms to electric vehicles to microwaves. This is a very valuable piece of tech here. And here there are 25 stocks or companies that are a part of this ETF. The expense ratio is 0.35%, and it manages about 2.1 billion euros of assets. This fund holds about 25 companies, the likes of Nvidia, and the top 10 holdings make up 74% with ASM, TSMC, Taiwan Semiconductor Manufacturing Company, and Nvidia, each sitting near the 10% mark. So that's where our next category of ETFs that we'll be looking at is more or less like your insurance policy, right? And this is gold, because gold is the ultimate hedge. It has no earnings, no dividends. There is no CEO making any promise. But when the whole market panics, gold shines like nothing else. The ETF in this category to consider is the Invesco Physical Gold ETF, SGLN. And the fee is just 0.12%. And that covers storage, insurance, everything. It manages 18.7 billion euros in fully allocated vaults. Remember, this is an ETC, not an ETF. So while ETF is exchange traded funds and is like a basket of securities like stocks and bonds, an ETC is exchange traded commodity. It focuses on commodities like gold, silver, oil, and you actually own the metal, not mining stocks, but the gold itself. When 2008 crisis hit, gold gained 25%. When COVID struck in 20 and the stock crashed, gold also surged while every other stock bond. You can look at gold as your insurance policy against financial chaos. The next category that we'll look at is the emerging markets. This is the growth funds, right? They are like the wild cards. They are higher risk, or there is a higher upside. The first ETF is Vanguard FTSE Emerging Markets ETF. So it could either be the VFEM or the VFEG. The expense ratio is the same. It's 0.22% for both of them. So while the VFEM distributes quarterly income dividends, so it's perfect if you want cash flow. The VFEG accumulates these dividends and reinvests them automatically. But it's the same index, same cost. The next ETF we'll look at is the SPDR MSCI EM Small Cap Index with ticker symbol EMSM. The expense ratio is 0.55%. It's a lot more expensive because it's small cap and it's harder to trade. It manages about 338 million euros as assets under management. This fund holds about 1,961 companies with only 3% in the top 10. So this adds local champions that you completely miss in large cap funds. So there you have it. 5 ETF categories that cover every major investment category, from the set and forget global funds to high octane semiconductor bets to emerging markets. Everything that you need to actually build up a solid portfolio is covered in this ETF. So if you've enjoyed the video, please drop a comment with your top ETF picks and tell me why you've chosen that. I read every single comment and I reply to all of them. If this breakdown saved you hours of research and thousands of fees, please smash that like button and it tells YouTube that this video actually made sense and they can show it to more investors or more people that need to invest. Please subscribe for more weekly money moves like this. And until next time, see you.